So here's the question that everyone is asking right now. Is silver done? Is the bull market over? Or, and this is what we are really going to dig into today, could silver still reach $200 an ounce? And if yes, what exactly would need to happen to get it there? Because here's the truth. Silver at $200 is not a fantasy number that some random internet permabull made up. It is a mathematically possible outcome, but it depends on one specific thing happening, something that has never happened before in the history of modern commodity markets, something so structural, so unprecedented, and so consequential that if it does happen, the ripple effects would extend far beyond just silver. Stay with me because by the end of this video, you are going to understand this market at a level that 99% of investors, including most professionals, do not. Let us start from the beginning. The extraordinary year silver just had. To understand where silver could go next, you first have to appreciate just how wild the past 12 months have been for this metal. 1 year ago, silver was sitting comfortably around $30 per ounce. Respectable, steady, mostly ignored by mainstream investors. Fast forward to today, February 17th, 2026, and silver is trading in the range of $79 to $83 per ounce. And that is after a massive pullback from its all-time high. Let that sink in. Even after dropping 30+% from its peak, silver is still up over 162% year over year. There are very few assets in any market anywhere in the world that can claim that kind of 12-month performance. Bitcoin gets a lot of attention. Tech stocks get a lot of attention. But silver? Nobody is talking about silver at the dinner table. Not yet. Now you might be wondering, if silver ran so hard, why did it crash so violently from that $121 high? This is really important to understand because the reason behind that crash is actually the same force that could eventually drive silver to $200 or beyond. It comes down to a battle between paper silver and physical silver. And right now, paper silver is winning. But the question is, for how long? Paper silver versus physical silver, the root of everything. Let us talk about something that most people have no idea exists. When you hear the silver price quoted on CNBC or Bloomberg, you are hearing the price of paper silver, specifically silver futures contracts traded on the COMEX exchange, which is part of the CME group in New York. These are legal contracts between buyers and sellers, committing to trade a specific amount of silver at a specific price on a specific future date. Here is the critical part. The vast majority of these contracts, historically somewhere between 95 and 98%, are never settled with physical silver. Traders simply roll their contracts forward, take a cash profit or loss, and move on. The system has worked this way for decades. It is effectively a financial betting system that also happens to set the price of a real physical commodity that the world actually needs. Now here is where it gets interesting. On one side of this equation, you have the COMEX registered inventory, the physical silver that is actually sitting in certified vaults and is immediately available to be delivered if someone holds their contract to expiry and demands real metal. As of right now, that registered inventory number sits at approximately 82 to 100 million ounces, depending on the week you are looking at, because these numbers are fluctuating wildly. On the other side, you have the open interest, the total number of outstanding futures contracts that have not yet been settled. The open interest on March 2026 silver contracts has been sitting between 85,000 and 91,000 contracts. Each COMEX silver contract represents 5,000 ounces. Do the math. That means the theoretical delivery obligation sitting in the March contract alone is somewhere between 425 million and 455 million ounces of silver. Compare that to the approximately 82 to 100 million ounces of registered silver actually sitting in the vaults. That means for every single ounce of silver available for delivery on COMEX, there are somewhere between 4 and 6 paper contracts claiming to represent that same ounce. Some analysts put the leverage ratio even higher, potentially 500 to 1 when you account for silver that is technically registered, but effectively encumbered or already spoken for. This is the fundamental imbalance at the heart of the silver market right now, and it is why the phrase COMEX default has become the single most important idea in precious metals investing in 2026. The one thing that gets silver to $200, a COMEX delivery failure. Here it is, the one thing that could realistically take silver from where it is today, around $80, all the way to $200 per ounce. It is a COMEX delivery failure, also called a COMEX default. What does that actually mean? It means that when a silver futures contract reaches its delivery date, the party on the other end, the short seller, cannot deliver the physical silver they promised. Instead of handing over actual metal bars, they would have to offer cash at whatever the then current price is, or the exchange would intervene and force a cash settlement. In plain English, it would mean that the COMEX cannot keep its core promise, that its silver contracts are backed by real, deliverable silver. Now, before we go further, I want to be completely honest with you about something. There are serious and credible analysts on both sides of this debate, Some argue, and they make valid points, that a true COMEX default is extremely unlikely because the exchange has multiple mechanisms to prevent it. The COMEX has the authority to raise margin requirements overnight, force position liquidation, and change settlement rules. History shows they used these tools during the 2011 silver spike, when they hiked margin 5 times in 8 trading sessions, crushing speculative longs and sending prices tumbling from $49 back down to $33. But here is what is different about 2026 compared to 2011. In 2011, the silver spike was almost entirely driven by speculation. There was no real supply crisis. The physical market was not under stress. The COMEX vaults were relatively well stocked. Today, the situation is fundamentally different, and that difference is what makes a delivery failure a genuine possibility rather than just an internet conspiracy theory. 5 structural forces that make 2026 different from every other silver spike. The silver market has been running a structural supply deficit for 5 straight years. Let me give you the actual numbers. In 2024 alone, the deficit was 148.9 million ounces. The 4-year cumulative shortfall going into 2025 was 678 million ounces, equivalent to 10 full months of global mine production. The 2026 deficit is projected to approach 200 million ounces. These are not small rounding errors. These are enormous, sustained gaps between what the world produces and what the world consumes. Every year that the deficit persists, above-ground inventories shrink, and when those inventories shrink below a critical threshold, prices do not just go up, they can gap up violently and with almost no warning. Force number 2. China designates silver a strategic asset. This is arguably the most underreported story in the silver market. China has classified silver as a strategic material and imposed export restrictions. Think about what that means. China has historically been one of the world's largest refined silver exporters, helping to plug the gaps between global supply and demand. By restricting those exports, China has effectively severed a major relief valve for the rest of the world. The Shanghai Futures Exchange is already trading silver at a premium of $3 to $5 per ounce compared to COMEX prices, a clear signal that regional supply is tightening faster than global averages suggest. This is not a temporary trade policy tweak. This is a fundamental reorientation of how China views silver, as a critical national resource rather than a commodity to be freely traded. Force number 3. Industrial demand is now inelastic. Here is something most people do not fully appreciate. Approximately 60 to 65% of all silver consumed globally goes into industrial applications. Solar panels, electric vehicles, semiconductors, 5G infrastructure, AI data centers, and medical devices. And unlike investment silver, which can be melted down and recycled when prices spike, industrial silver is consumed and gone. A solar panel manufacturer does not have the option to simply skip silver. There is no alternative element that matches silver's electrical conductivity at a comparable cost. Neither do the chip makers nor the EV battery manufacturers. This demand is effectively inelastic, meaning it continues regardless of price. Solar panel manufacturers alone consume approximately 20 to 30 million ounces per year. The EV sector adds another 15 to 20 million, and both are growing fast. These sectors provide a floor underneath silver prices that simply did not exist in previous cycles. Force number 4. COMEX registered inventory has fallen 75% since 2020. Here is the physical reality on the ground. Since 2020, registered silver on the COMEX, the metal that is actually warehoused, vaulted, and immediately available for delivery, has fallen by approximately 75%. In just 1 week in January 2026, over 33 million ounces were physically withdrawn for delivery. That single week represented roughly 26% of total registered inventory, vanishing in 7 days. Meanwhile, in early February, deliveries for the February contract alone already reached 13.8 million ounces with no sign of slowing. The pace of physical withdrawal has no historical precedent at this scale. Long position holders are not just speculating on price anymore. They are demanding real metal and pulling it out of the system. Force number 5, central banks are adding silver to reserves. For 70 years, the rule was simple. Central banks buy gold, not silver. That began changing in early 2026. Russia, facing Western sanctions and seeking assets that can withstand U.S. financial pressure, has reportedly begun accumulating silver alongside gold. Other emerging market central banks have followed suit. When central banks treat an asset as a monetary reserve, it transforms the demand profile entirely. Central bank buying is patient, persistent, and price insensitive. It does not sell at a loss. It does not panic. And it never rolls its futures contracts. When central banks buy silver, they buy physical bars and take them off the market permanently. What a COMEX default would actually look like. Let us walk through exactly what a COMEX delivery failure would look like step by step, because the mechanics matter if you want to understand the price implications. As a major contract month, let us say March 2026, approaches its first notice day, contract holders who want physical silver declare their intention to stand for delivery. Under normal circumstances, maybe 2 to 5% of open interest actually demands physical metal. But what we have been seeing in January and February 2026 is dramatically elevated delivery demand. In 1 week alone, 26% of registered inventory was withdrawn, if even 20% of the March open interest demands physical delivery. And remember, that contract represents 425 to 455 million ounces in theoretical obligations. COMEX would need to deliver approximately 85 to 90 million ounces. The registered inventory is already below that level. At that point, the COMEX has several options, none of them good. Option 1. Eligible silver gets converted to registered silver at emergency speed. The problem is that eligible silver, while stored in COMEX-approved vaults, requires the owner's consent to become deliverable. You cannot just flip a switch and turn eligible silver into registered silver without the permission of the people who own it. And increasingly, those owners do not want to let it go. Option 2. COMEX raises margin requirements dramatically, just as they did in 2011. This forces leveraged longs to close their positions and reduces the delivery demand. However, if the demand is coming from legitimate industrial users and sovereign buyers rather than leveraged speculators, margin hikes will not stop them. They are not using leverage. They want the metal. Option 3, force cash settlement. This is the nuclear option. If the COMEX announces that contracts will be settled in cash rather than physical silver, it would be an admission that the paper silver market is exactly what critics have always claimed, a fractional reserve system that never intended to deliver real metal. That announcement, cash forced settlement, is the event that would trigger the $200 price spike. Because the moment the paper market loses credibility as a price discovery mechanism for physical silver, buyers who need real silver would have no choice but to go directly to the physical market and pay whatever price clears the market. With a 5-year cumulative deficit of nearly 700 million ounces, with China restricting exports, with industrial demand inelastic, with central banks buying, that clearing price could be far higher than $200. Now look, I told you I was going to be honest with you, and that means I have to give you the full picture. There are smart, credible analysts who believe the COMEX default narrative is overblown. Here's their strongest argument. Open interest does not equal delivery demand. The total number of outstanding contracts is a dynamic, constantly shifting number. It is not a pile of silver owed to specific people. Traders roll contracts forward, close positions, take cash profits. This is the normal rhythm of futures markets. The historical delivery rate on silver futures is somewhere between 2 and 5% of total open interest. Even at the elevated delivery rates we have seen recently, the exchange has mechanisms to manage the flow of physical metal without running dry. Additionally, COMEX has the eligible silver buffer. The total COMEX warehouse inventory, registered plus eligible combined, is around 400 million ounces. The registered portion is small, but eligible silver can be converted relatively quickly. If prices rise high enough, the economic incentive to convert eligible to registered and sell becomes overwhelming. And Seeking Alpha analysts at Conservative Income Portfolio published a detailed piece in February 2026, stating bluntly that at present there is a 0% chance of a COMEX default, pointing to historical parallels with 2011, and arguing that the delivery mechanics have always been more flexible than default alarmists suggest. These are not unreasonable arguments. They deserve to be taken seriously. The question is whether the structural forces in 2026 are truly different enough to overcome the COMEX's considerable institutional power to manage and suppress delivery stress. That is a question that no one can answer with complete certainty, which is why this market is so volatile right now. What the price data is telling us right now. Let us look at where silver sits today and what the technicals and fundamentals are telling us about near-term direction. As of February 17, 2026, silver is trading in the range of $79 to $83 per ounce. The gold-silver ratio sits at approximately 63 to 65 to 1, meaning gold is 63 to 65 times more expensive than silver on a per-ounce basis. Historically, this ratio averages somewhere between 15 and 47 to 1, with the most extreme compressed ratios occurring during silver's biggest bull runs. Silver has now posted 3 consecutive weeks of declining prices, a technical signal that the market is in a corrective phase after an extreme overbought condition. The metal printed its all-time high of $121.67 on January 29th and has since lost approximately 33 to 35% of its value in the correction. That sounds dramatic. But in the context of a metal that went up 162% in 12 months, a 33% retracement is actually a fairly normal and healthy correction. The macro backdrop continues to be broadly supportive. The Federal Reserve is now expected to cut interest rates by approximately 60 basis points by year-end. 2 cuts are priced in for the second half of 2026. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver, making it relatively more attractive. Meanwhile, U.S. economic data has been softening. December retail sales unexpectedly stalled. The GDP control group fell by 0.1%. Weaker economic data typically leads to more dovish Fed policy, which is positive for silver. U.S. Treasury Secretary Scott Bessent publicly attributed some of the recent extreme price swings to Chinese traders engaging in speculative activity, which suggests Washington is watching this market very closely. When government officials start commenting publicly on commodity price action, it is usually a sign that something significant is happening beneath the surface. Where is silver headed next? Multiple scenarios. Let me give you 3 concrete scenarios for where silver goes from here, based on the data we have in hand today. Scenario 1. The soft landing. Silver trades between $60 and $90. In this scenario, the COMEX manages delivery pressure through a combination of margin hikes, eligible to registered conversions, and the natural rolling of contracts. The Federal Reserve cuts rates modestly. Industrial demand continues at a high level, but does not accelerate dramatically. Chinese export restrictions remain in place, but do not tighten further. In this environment, silver stabilizes in the $60 to $90 range for most of 2026. Still historically elevated, still profitable for those who bought under $50, but not the explosive move that bulls are hoping for. JP Morgan's official forecast of $81 per ounce for 2026 average falls roughly in this range. It is the institutional consensus baseline. Scenario 2. The institutional breakthrough. Silver tests $100 to $150. In this scenario, 1 or 2 additional major institutional investors publicly announce large silver positions. China tightens its export restrictions further, or officially adds silver to its national strategic reserve. The Federal Reserve cuts rates by more than expected, weakening the dollar meaningfully. The solar panel and EV sectors report quarterly demand numbers that shock to the upside. COMEX registered inventory continues to fall, but does not hit zero. Instead, rising prices attract enough new metal from smelters and miners to prevent a full-blown delivery crisis. In this environment, silver retests the $90 area and then breaks above it, potentially reaching $100 to $150 by the fourth quarter of 2026. Several independent analysts, including Alan Hibbard at Gold Silver and A.G. Thorson at FX Empire, have published forecasts in this range, with Hibbard targeting $175 or more. Scenario 3. The COMEX default. Silver spikes to $200 and beyond. This is the one thing scenario. The March or May 2026 delivery cycle sees an unprecedented percentage of open interest stand for physical delivery. COMEX registered inventory falls below the level needed to fulfill obligations. The exchange is forced to choose between hiking margins so aggressively that it triggers a market-wide liquidity crisis, or announcing forced cash settlement for some contracts. The cash settlement announcement breaks the credibility of the paper silver price as a reference for physical metal. Industrial users, sovereign buyers, and investors who need real silver rush to the physical market simultaneously. The gold-silver ratio compresses dramatically from 65 to 1 toward the historical range of 15 to 20 to 1, implying a silver price north of $200 if gold holds around $3,000 to $4,000. Some extreme bull scenarios put silver at $300 to $500 in a true delivery failure, but those numbers require assuming a complete breakdown of the global financial system around commodity markets, which remains an unlikely tail event. Signals to watch. Your early warning system. Whether you are a current silver holder or someone considering entering this market, here are the specific things you should be watching every single week that will tell you which of those 3 scenarios is unfolding. First, watch the COMEX registered inventory number. This is reported daily. The trend is your friend here. If registered inventory is consistently falling week after week, the delivery pressure is real. If it stabilizes or starts recovering, the squeeze is easing. Right now, the trend is down. Registered stocks have fallen 75% since 2020, with the most dramatic declines happening in January and early February 2026. Second, watch the backwardation. Normally, futures prices for silver deliveries further in the future are higher than near-term prices. This is called contango. When the opposite happens, when near-term prices are higher than future prices, it is called backwardation. Backwardation in silver is a screaming signal that the physical market is tight. Right now, we are seeing elements of backwardation forming in silver. If that deepens, it is a major warning sign. Third, watch the exchange for physical spread, also called the EFP. This is the premium that buyers pay to swap a futures contract for actual physical metal. When the EFP widens, and we have seen it reach as high as $1.10 per ounce in recent weeks. It means physical silver is commanding a premium over paper silver. That gap should theoretically be zero or near zero. When it is not, something structural is happening in the physical market. Fourth, watch the gold-silver ratio. If gold keeps rising and silver starts to outperform, meaning the ratio compresses below 60, that is a historically reliable signal that silver is entering a powerful outperformance phase. A ratio compression from 65 to 40 would imply silver around $90 if gold stays at $3,600. A compression to 30 would imply silver around $120. A compression to 20 would imply $200. Fifth, watch the CFTC Commitment of Traders report, released every Friday. This shows the positioning of commercial traders, large speculators, and small speculators in the silver futures market. When commercial hedgers, the mining companies and industrial users who are closest to the physical market, start dramatically reducing their short positions, it is a signal that they see higher prices coming and no longer want to bet against their own inventory. Let me be very direct with you here, because I know a lot of people watching this video are trying to figure out what to actually do with this information. I am not a financial advisor. Nothing in this video is financial advice, but I can give you the framework that serious investors use when analyzing a market like this. The silver story in 2026 has two separate layers. The first layer is the long-term structural story. 5 years of supply deficits, inelastic industrial demand from solar and EVs, China restricting exports, central banks diversifying into silver, the dollar losing credibility as a global reserve currency anchor. That structural story is intact. It was intact before the spike to $121. It is intact now at $80, and it will be intact at $50 if we get another correction. The structural floor under silver is genuinely higher than it has ever been. The second layer is the COMEX delivery story, the potential for a paper silver market failure that triggers an explosive repricing of physical silver. This is the speculative tail risk scenario. It has never happened before. It might not happen. But the conditions for it to happen are more fully formed right now than at any previous point in modern market history. Experienced precious metals investors typically structure their exposure accordingly. Physical silver, coins, bars, allocated accounts, captures the structural story with maximum safety. Silver ETFs like SLV give paper exposure without physical risk, but come with counterparty concerns in an extreme scenario. Silver mining stocks offer leveraged exposure to the silver price with company-specific risks. And physical silver held outside the banking and futures system, what some analysts call silver outside the COMEX, is the ultimate hedge if the paper market fails. The final verdict. Can silver really hit 200? Host pauses. Direct eye contact with camera, serious tone. So let us bring it all home. Can silver really hit $200 per ounce? Here is my honest assessment based on everything we have covered today. In the base case, the most likely scenario, silver probably does not reach $200 in 2026. The COMEX has too many tools to prevent an outright default. Margin hikes, position limits, emergency rule changes, and the sheer institutional inertia of a system that has survived multiple squeeze attempts will likely prevent the worst-case delivery failure. JP Morgan, Bank of America, ING, and HSBC collectively see silver averaging somewhere between $55 and $81 in 2026. That range reflects the real structural bull market without assuming a COMEX breakdown. But here is what is different about 2026, and what makes even the conservative analysts uncomfortable. The physical silver market has never been this structurally tight during a period of simultaneously elevated industrial demand, Chinese export restrictions, potential central bank accumulation, and sustained 5-year supply deficits. Every single one of those forces is real and data confirmed. They are not conspiracy theories. If, and this is the big if delivery demand in the March or May 2026 contract month exceeds what the COMEX can realistically deliver through all its mechanisms, the paper price discovery function of the COMEX breaks down. And when that happens, physical silver immediately reprices to whatever level industrial users, sovereign buyers, and panicking investors are willing to pay. Given the supply fundamentals, that number could absolutely be north of $200. Some analysts who have studied historical commodity squeezes closely the 1979-1980 Hunt Brothers corner, the 2011 silver spike, the 2021 retail squeeze attempt, argue that a true delivery failure in 2026 could push prices into $300, $400, even $500 territory before a new equilibrium is found. So the answer to our title question, could silver really hit $200, is yes, absolutely yes, but only if the COMEX faces a genuine, unmanageable delivery failure. That is the one thing. Not a Fed rate cut, not another Chinese speculative wave, not a dollar crash, not a geopolitical crisis. Those things will push silver higher. But $200? That requires the paper market to break. And while that has never happened before, the structural conditions for it to happen have never been stronger than they are in February 2026. Watch the registered inventory. Watch the backwardation. Watch the EFP spreads. Watch the gold-silver ratio. Those four numbers will tell you in real time whether the squeeze is intensifying or releasing. And if you see all four moving in the wrong direction simultaneously, that is your signal that the one thing everyone is afraid to say out loud is actually happening. That is everything I've got for you today. We covered where silver is right now, trading around $79 to $83 per ounce, down from its all-time high of $121.67, but still up over 162% year over year. We talked about the COMEX paper versus physical imbalance, the 5 structural forces driving the 2026 bull market, what a delivery failure would actually look like, 3 scenarios for where prices go from here, and the exact signals you should be watching every single week. The silver market in 2026 is not ordinary. It is not a simple buy the dip trade. It is not a simple avoid the volatility moment either. It is one of the most complex, high-stakes commodity market setups of the last 30 years. And the fact that most mainstream investors are not paying attention yet is, if you are a long-term silver bull, the most bullish signal. L of all, excited. If you got value from this video, please hit that subscribe button. Turn on notifications. Because when the COMEX data moves, when that registered inventory number ticks down below a critical threshold, when the backwardation deepens, when the EFP spread widens to $2 or $3, you are going to want to know about it the same day, not 3 days later, not next week, that day. I will be covering this market every single week with fresh data, fresh analysis, and zero hype. The silver story of 2026 is far from over, and the next chapter could be the most dramatic one yet. Pause. Until next time, stay curious, stay informed, and as always, do your own research.